What is the Obamacare Surtax and should you be concerned about it? That's what we'll be talking about in today's video. Hi there, welcome to another episode of The Power of Zero. I'm best-selling author David McKnight. Today we're going to be talking about the Obamacare Surtax and if it's a pitfall you'll need to watch out for in retirement. First, a little background. Back when Obamacare passed in 2013, you may have heard of something called the Obamacare Surtax. This was an extra 3.8% on investment income that was designed to help fund the additional costs of Obamacare. For starters, let's talk about who this tax is likely to affect. This is not a tax that's levied on earned income. It's a tax on investment income, but not everyone pays it. You'll only have to pay it if, as a single person, you make more than $200,000, or if as a married couple, you make more than $250,000. So to show you how this tax works, I'm going to give you an example of a married couple who is making $225,000 per year, but has investment income of $100,000. When you add the $100,000 of investment income to their $225,000 of ordinary income, that brings their total income to $325,000. Any investment income over the $250,000 of total income would be taxed at 3.8%. So in this case, this couple is $75,000 over the $250,000 threshold. Therefore, they would owe 3.8% tax on $75,000 or $2,850. It's important to note that for the purposes of this calculation, your investment income is always stacked right on top of your ordinary income. If a married couple only had $100,000 of ordinary income, but had $100,000 of investment income, they wouldn't owe that 3.8% because their total income is only $200,000, well below the $250,000 threshold. So the big question that we have to answer at this point is, do you need to worry about this at all? After all, very few married couples make more than $250,000 a year, and even fewer have substantial amounts of investment income. Well, at this point, it's important to understand what counts as investment income for the purpose of this tax. It could be any big investment windfall, proceeds from the sale of your home in excess of $500,000 for a married couple and in excess of $250,000 for a single person, which frankly is not very hard to do in today's real estate market, or the exercise of stock options. It also includes things like interest, dividends, capital gains, rental income, royalties, and even things that can be construed as passive investment income. It's also important to understand that all forms of income go into the overall calculation of determining whether you reach that minimum Obamacare surtax threshold, which, as a reminder, is $200,000 for single filers and $250,000 for married filers. It's also important to remember that this 3.8% only applies to the investment income that reaches above and beyond the $250,000 threshold. And as a reminder, that investment income is always stacked on last. Before we go any further, I'd like to ask the Power of Zero question of the day. What are you doing to blunt the effects of the Obamacare surtax? Feel free to put your answers in the comments section below. Now, you may be wondering, how would this affect me if I'm planning on doing a Roth conversion, which many of my listeners are planning on undertaking at some point in the next 10 years? Well, it can potentially be a big deal depending on your situation. Here's an example. Let's say that your taxable income is $100,000. Let's also say that you would like to convert to the top of the 24% tax bracket, something that we frequently advocate. That would push your total taxable income up to $340,100. Well, guess what? $340,100 is above and beyond the $250,000 threshold. So any investment income that you realize during that Roth conversion period is going to be hit with that 3.8% Obamacare surtax. So if you're planning on selling a house that's valued at substantially more than $500,000, this may give you pause because you will be paying that extra 3.8% on any of the capital gain you experience above that threshold. Likewise, if you're planning on exercising some stock options during a Roth conversion period, you may want to look at this calculation pretty closely before doing so. Now that we've laid out the basics when it comes to the Obamacare surtax, I'd like to make 3 observations that should help inform your approach to this tax. First, Not very many people pay it, and if they do, they don't take a substantial hit. This is because the average run-of-the-mill investor has most of their savings in 401ks or IRAs, and so they don't experience a lot of net investment income. Second, even if you do have to pay this tax, it's only 3.8%, and when we're facing the specter of tax rates potentially doubling over time, I would not let the 3.8% tax tail wag the dog. Remember, if you don't want to liquidate an investment now because you want to avoid paying the 3.8% tax on it, then you're choosing to pay that tax somewhere down the road. And if you push that payment of that tax too far down the road, you'll almost certainly be liquidating that investment at a period in time when capital tax rates will be much higher than they are today. By the way, all of this once again highlights the importance of getting to the 0% tax bracket in retirement. Remember, any distributions from Roth IRAs, Roth 401ks, Roth conversions, or loans from cash value life insurance don't count towards that $200,000 threshold if you're single or the $250,000 threshold if you're married. And if those distributions don't count as income, that further lowers the likelihood that you'll be hitting the Obamacare Surtax. Just remember, if you do want to avoid this tax in the years leading up to retirement, just be cautious during the period in which you're doing Roth conversions and realizing some big windfall investments such as the sale of a stock, exercising stock options, or selling an expensive home. So what are my final thoughts on this? The Obamacare surtax is a pesky little tax that will affect the top 1% of Americans fairly consistently and middle-income America only occasionally, particularly in the years where they have a one-time windfall event. Again, don't let the Obamacare surtax tail wag the dog on this, because even if you do have to pay this tax, you're doing so at a period in time where tax rates are historically low. And if you postpone the payment of a capital gain tax or a Roth conversion to some point much further down the road, just so you can avoid paying this 3.8% tax, you may be surprised with a much higher tax on your ordinary income or your capital gains. If you need some help navigating these types of strategies, head on over to davidmcknight.com and opt in for a complimentary strategy session. I'm happy to give you a hand. Don't forget to click like, subscribe, and the bell so you never miss a video. And feel free to make comments or ask questions in the comments section below. This is David McKnight. I look forward to seeing you on the next video.